You're watching Trading Day. Take a look at that TSX having a pretty strong up day at this moment. Again, the backdrop against this is no real catalyst and volumes are kind of light. But we have been under some selling pressure. So at least that pressure was enough to entice some investors back into the fray. Let's bring in Todd Sohn, ETF and technical strategist at Strategas Research Partners. Todd, thanks as always for joining us. June has been an unpretty month for TSX investors.
Yeah, it's nice to see you too, Amber. And I would call it the early innings of a summer speed bump, not only for the TSX, but for global equities in general. Now, you mentioned NVIDIA reversing and some of the other portions of the market holding up well. This is where the value of the TSX comes into play. You have energy bouncing, you have financials holding up well. That's great for Canadian investors because of how much influence they hold over the index. Now, you had a modest oversold condition for Canadian equities recently. I'm curious to see how the response is going forward, right? If it's something that is durable, has a lot of participation behind it, it's enough to carry us to new highs. But if it's only going to be driven by a few different names, that leaves me a little bit more skeptical that we are through this corrective environment just yet. So sit tight. The good news is the TSX still has pretty good support underneath it going forward.
Yeah, I guess that's the question. We didn't even really pull back 5%, even though we've been successively moving lower over the last couple of weeks. It wasn't a cratering by any stretch. Kind of just as boring on the way down as it's been on the way up.
Yeah, and I will say this, low vol isn't something to fear, right? Just because you may get a sense of complacency, right? If there hasn't been a 1% decline for some time or whatnot. Low vol is actually characteristic of bull markets. So I like seeing these kind of shallow pullbacks, right? I would prefer to see a deeper oversold condition to get more confident that it's time to add exposure. But if you look back to even say the 1990s, whether it's for the TSX or for the S&P 500, you can go months without having some sort of a deeper pullback. Or if you look at the VIX, you can have a subdued VIX for years and have these great equity market runs. So I would not look to the low vol type environment as something of complacency, but rather a characteristic of a very sound underlying market.
Well, I'm glad that you brought that up because that was going to be my next question. Volatility subdued. Also, the stat that's going around is that it's been like a record more than 370 days since the S&P has pulled back more than 2% in a single day. Rather than being something we should fear, Todd, your point is this is almost a green light for equities.
Exactly. And I go back to the early to mid 90s, especially for if you use the S&P 500, if you use the VIX there, the VIX spent that whole entire time as we can call it a teenager with a teenager type number on it, right? And if you were to say, the VIX is too low back then, it would have kept you out of one of the greatest equity market runs in history. And so, yes, eventually this streak will end. Right. And it's a matter of, okay, after that first initial hit, what does market leadership look like? What does market internals look like? If leadership is still risk seeking and the internals are still firm, as I would say they are in general, then that's going to be a pause or a volatility event that you're ultimately going to want to end up buying. And of course, it'll break the streak. It may scare you in the very short term. But again, I go back to this big picture idea that low volatility historically is part of what makes a great durable equity one higher, whether it's the US, Canada, Europe, and Japan. Do not fear the low vol type environments that we're in.
Well, I'm glad that you brought that up as it relates to the U.S. And I want to unpack, does that apply to the TSX? And I know being Canadian, of course, we obsess over the TSX diverging from those U.S. markets, but it's really not just the TSX, right? In Europe, June has not been a great month, particularly for the French markets. Even, Mexico June has not been a great month. So globally, there seems to be a rollover in everything but the U.S. markets.
Yeah, and even if you look away from the cap weight S&P 500, the equally weighted S&P 500 paused back in March. So we're going around 2.5 to 3 months of the average stock consolidating, just like you saw in those countries you mentioned. And I think that's okay, especially coming off of the low last October. We had one of the great 6 to 8 month runs in history, frankly, in terms of momentum. And so you're going to see some sort of speed bump. That's quite all right. But I do want to pay attention to what the equal weight S&P 500 does going forward, right? The cap weight has diverged, has continued to make new highs. If the equal weight S&P 500 can start to resume higher too, that would be more reflective of sectors like industrials, energy, and financials starting to reaccelerate higher. Conversely, if you have the cap weight index continue to make new highs and the equal weight index rolls over, that's going to create a durability issue when I start to get much more concerned in terms of what the future may hold. And so right now we're okay, but it's all about how these equal weighted constructions start to move forward throughout the summer.
And is anything a screaming buy right now? Everything just kind of seems like, I don't want to say boring because it's my job to kind of sell the excitement of the market, but it just seems like what are we there to get excited about?
Yeah, I think when you look at flow data, right, flows have been all in on technology, and that's been correct, right, especially with the way NVIDIA and Microsoft have acted. But if you look at every other sector, healthcare has had major outflows over the last year, energy, financials, there hasn't been a lot of enthusiasm for other sectors. And if they can ever start to outperform, if tech ever takes a break, I think that's going to be real ample opportunity for investors, especially those who are more active, to start to get involved there and have a lot of runway before much more aggressive positioning takes place. And so I like the idea of tech perhaps consolidating here, especially the way flows have looked, and looking to these other sectors that really have not had much endorsement over the last 6 to 12 months.
Well, that really challenges the notion, too, that we need tech to support the market. And maybe tech is actually sucking out the oxygen out of the room. And if it were to take a break, those flows could have permission to go elsewhere.
Yeah, and tech, right, has definitely sucked the air out of the room. They are the biggest players within the index. They are supposed to score the most points, supposed to have the largest influence on the S&P 500. So it could be frustrating for the passive index-based investor if those names do correct. But I think if you're looking for more excitement, more things to work, it's those other areas of the market. And it's even in the TSX. I love using Canada as a value proposition for a portfolio. The S&P 500 U.S. markets are very growth and tech heavy. If I want something that's more value oriented, I'm going to look to Canada where I can get that energy exposure and the financial exposure in a very pure way because of how influential they are for the index up north.